All right, so that was the top brass at the Reserve Bank of India, the governor and the deputy governors briefing the media post the policy. No real surprises really, but one thing that the governor repeatedly wanted to reiterate is this policy is just a pause. It is not a pivot. Now, how do we read into that? And a lot more comments that have been made through the course of the day. We have a special set of guests joining us to pass through these comments that have just come in. We have with us Mr. Neeraj Gambhir from Axis Bank, Jairam Sridharan from Piramal Retail Finance, Soumya Ghosh from State Bank of India, Pranjul Bhandari from HSBC, Mr. Ashutosh Khajuria from Federal Bank, and Mr. S.S. Mundra, who is the former Deputy Governor of the Reserve Bank of India. Pranjul and gentlemen, thank you very much for being here. Mr. Soumya Ghosh, if I could start with you. How do you read into this statement? The big question that the market really wants to know is, have we reached the end of the rate hiking cycle, or like the governor just says, this is a pause, not a pivot?
Yeah, thank you, Ritu. I think this is a very nuanced and communication that it's only for this policy, because that actually prepares the market for any future rate action if suppose the inflation trajectory does not play out the way it should play out as per the RBI prognosis. Now, having said that, if I look into the inflation projections for the next couple of months, it seems to me that they will be much lower than the current numbers. And from that point of view, a rate hike at this point would be ruled out. But the bigger question, Ritu, over here is that I think the distinction between policy strategy and policy stance. While the stance of the policies continues to be withdrawal of accommodation, even though liquidity is deficit mode, but as the Deputy Governor mentioned, that because of the huge government spending, that has come back to a little bit of surplus in the month of April, which may be a temporary phenomenon. So going forward, I think this is what the RBI will have to treat very carefully, because strategy, it has opted for a pause because of it wants to give the system and wants to see how the rate hikes will transmit through the system. The past rate hikes of 250 basis points, which is actually 290 as per the RBI. And also the stance, because they have kept withdrawal of accommodation as the option. But given the fact that the government borrowing program, the currency withdrawal, the Reserve Bank of India cannot continuously do a VRR over a point of time. That will mean that the RBI is actually, that could be a conflict between the strategy and the stance. So I think in the next couple of months, or maybe possible in the month of May, when the government borrowing program will be very heavy, we'd like to see that how this distinction between strategy and stance pays out, because at some point of time, this is what all central banks are trying to do. The Fed balance sheet, in fact, expanded in March, even though it was hiking. So I think, and that's going to be the most crucial distinction, which the RBI also will have to make in the next policy or before that.
Pranjul, what is your sense? The fact that RBI is also continuing with its stance of withdrawal of accommodation, perhaps to give it elbow room to act in future, and indicating again and again the pause is only for this meeting, coupled with the fact that the inflation forecast, if you look at it, even in the MPR paper that has been released, for FY25, the average is seen at around 4.5%. So we're not getting to that 4% midpoint anytime soon.
Yeah, thank you very much for this. Look, my sense is that RBI was running a marathon. It gave you that effective more than 300 basis points increase in rates, and then it stopped suddenly. Now, some parts of this stopping make sense. For instance, they've reduced their oil forecast, they've reduced some of their inflation forecasts, but some of them don't make sense to me. For instance, the timing. Just right now we are seeing two inflation prints above 6%. Was this the right time to actually pause? And also, if you look at some of the commentary, they actually say that core inflation is unyielding. They say that policy rate remains extremely accommodative. So does the pause really make sense from this? I think there were a few things I felt a little uncomfortable with. But going ahead, my sense is that if they did not hike rates when inflation was 6% plus, they may not be in a big hurry to hike rates, in the next year, when we are all forecasting inflation to actually average below 6%. So my base case is perhaps no more rate hikes from here, but the risks remain. And for me, the biggest risk is the currency. I think a lot of people don't really appreciate it. But one of the reasons perhaps why the RBI paused this time was because the rupee was fairly stable, has been fairly stable in 2023, very different from what happened in 2022. My sense is if some instability were to come back for any reason, dollar movement, Fed hikes, and so on and so forth, then we may see the RBI move again. But that I would say is a risk case. And to your second part, I'll quickly take 20 seconds. On inflation forecast for FY25, they do have a forecast of 4.5%. So coming closer to the 4% target, but my sense is that is a bit optimistic. My sense is a lot of changes have happened in the pandemic. Large firms have gained pricing power. We are seeing far more climate change events, which are keeping inflation expectations high. I think we are a long way away from 4. And what we have today is a situation in which we've probably elbowed out the room to cut rates. The fact that we've paused today, we've elbowed out the room to cut rates meaningfully in the next couple of quarters.
Okay, so an extended pause, and of course the elbow rate to cut rates perhaps is not coming anytime soon. And the inflation forecast, like you pointed out, 4% is a long time away. Jairam, Sridharan, let me come to you as well. The bond markets are happy, the markets are happy, there was no hike, and there's been a pause. Growth forecast has been upped, even though many are questioning if it's a little too optimistic, and inflation forecast has been brought down. Banks and NBFCs not so happy. Jairam?
Oops, sorry.
If you can hear me, what happens to your lending rates from here on?
Yeah, I would say that, I think the policy today is an appropriate acknowledgement of some realities that have been with us over the last few weeks and couple of months. Loan growth is slowing. It is still quite robust, but from a peak of 17% loan growth is down to 15%. Liquidity in the market has been tighter than some of us might like. NBFC liquidity, particularly kind of below the AAA level, has been tight, and that does show a little bit of reducing risk appetite in the market. And yield curves have been kind of nearing inversion levels. So all these kind of tell you that the situation, today was getting to be tight from a growth standpoint. The RBI policy of a pause right now seems just an acknowledgement of this thing. I don't know that I would read too much into what it means for next quarter or the quarter after, etc. But clearly, right now, it seemed like they clearly felt that this was the right thing to do. I will say that in the RBI advisory panel of market participants, like 90% had voted for an increase, and our chief economist was one of the 10%. So shout out quickly to Devopam Chaudhary, who has been very active and vocal in talking about the need for a pause right now, given some of these items that I just spoke about. I do think that there is a little bit of a risk that that growth slows to a point where it becomes hard to crank it up again. And as the governor said, our policy choices are a lot more dependent on domestic factors than on what's happening in the global and whether and what Fed does, etc. And I see this as an appropriate acknowledgement of where the economy is right now, without trying to forecast too much into what the next quarter or two might entail.
Yeah, I can't. Hello. Okay, I just wanted to ask, what are the key takeaways from the press conference itself? Let me start with the Economist. Soumya, what did you take away? They kept saying that this policy is valid only till June 8th. So do you still think there is a chance of a rate hike?
No, I think that communication is very balanced and nuanced. But if I look into the inflation trajectory, because in June you'll have two numbers before them, and both these numbers will actually be lower than the previous number. So from that point of view, I don't think a rate hike is going to happen based on pure inflation trajectory. So this is my observation. The second observation, which is also very interesting, is that I think the governor has clearly said that core inflation has been unyielding. So instead of the term sticky, now unyielding. So basically, that's one interesting communication to the market, which I would like to watch out more closely. But my sense is that as of now, and as I've said to Ritu in the beginning, the greatest challenge from the RBI is liquidity management, the strategy decision and the stance decision, and make both of them reconcile at the same point of time.
Okay. Well, Pranjul, the same question to you. Considering that both Patra and the governor kept saying, and in particular Dr. Patra, that our assessment is valid only till, June 8th, and beginning by saying this is a pause, not a pivot, is all this giving the impression that we should not rule out rate hikes completely?
Well, I'll agree with Soumya, Kanti, Ghosh on this one, that, if they did not hike rates when inflation is north of 6%, then it looks a bit, it looks a bit unrealistic to think that they may hike rates when we actually see inflation fall below 6% in the next 12 months, which is our forecast, which is also RBI's forecast, perhaps led a little bit by base effects. So look, from that perspective, no, I don't think, we don't have a forecast now of the RBI continue to hike from here, but I think the risk remains. And the big thing I look at is the rupee, which has been extremely stable in 2023 after a very volatile 2022. But if that instability would get challenged in any way, then I think we might see more rate hikes. And I think there are two ways in which the stability gets challenged. One is if Fed ends up hiking more, if we see dollar strengthening, leading to what happened all of 2022, if that sort of re-emerges. And the second is if we get any negative surprise on the BOP. We are all right now celebrating the fact that services exports are doing very well and the current account looks in a good place. But there are a lot of uncertainties on the capital account front. We don't know where portfolio inflows are going to go. FDI has shown many signs of slowing. Loans inflows, ECBs have also started slowing. Startup funding has fallen 75% between 1Q and 4Q 2022. So there are many moving parts on the capital inflows part of the BOP. So I think the currency will be the main determinant of future rate actions for the RBI in the next couple of quarters.
Fair point. Okay. I know external situation, though they kept saying that as well. Now let me get to the bankers and the people who give out money, the lenders. Mr. Mundra, first up to you. Are you getting a sense that credit offtake will pick up? I mean, if this is the peak rate, then do you think that we can expect more robust credit demand in the days to come? I'm not able to hear you, Mr. Mundra.
Sorry, I was I was on mute.
Mute.
Credit demand has been, if we look at relatively, had already been fairly strong. I think the challenges which the lenders were facing was more on the liability side of the balance sheet, that is regarding the mobilizing the deposit and cost thereof. So from that sense, I think this pause should bring some relief on that. I don't expect that this one action with so many, attached comments to it, that it should be looked at as a one-time event, is going to make any overall change in the outlook or strategy of the bank towards the credit dispensation. But yeah, for a while it would be positive. But I think I'm also a little intrigued about this pause and the repeated comment that it is for one time and it should not be looked as a pivot. It is only a pause, particularly when the inflation has been elevated since December. And even if I look at the RBI forecast about the GDP growth as well as the inflation in the coming year, but more importantly, if I look into the quarterly break which they have given, so while the GDP growth projection at 6.5%, but first quarter 7.8, and then there is a sharp fall to 6.2, 6.1, and 5.9. And similarly, inflation average 5.2, but the Q1 5.1, then 5.4 for 2 quarters, and then coming back to 5.2. So I think there is much more to read and understand about this pause which has been mentioned. Maybe government borrowing is one of the factor which might be weighing on the mind. And similarly, there had been certain cautionary note about the oil price trajectory as well as the monsoon trajectory. So I think if I put everything put together and then link it to your question, this one particular thing with so many notes of caution already there are not going to make any major change in the credit trajectory from what it has already been till now.
Okay. Okay, time permitting, I'll toss that to the others as well. But Neeraj, first up, do you think now the peak rate of 10-year is whatever, 7.3, 7.4, we don't go above that? So companies have some kind of stability in terms of costing, calculating their cost of capital. Also, overall, your assessment of the rupee, does it strengthen from here?
So, Lata, a couple of points. First of all, pause, not a pivot, would like us to believe that take one policy at a time. Don't try and forecast too much out of it. But I think the market will ask the question that what will it now take Reserve Bank to hike from here onwards over the next, say, 6, 9, 12 months? And as the economists have pointed out, the inflation trajectory is looking quite sobering. So the chances of a rate hike are lower. So I think that is going to get priced into the market. We've already seen 10-year bond yield come down to roughly 7.20. And if this view kind of keeps on gaining ground, then I think we could see some more slide down towards 7% in terms of the bond yields. I do expect that the market will be very range bound because effective this week, the supply is also starting. The government is going to come into the market with its borrowing program. So there will be some pressure from the supply side, but I think this policy will kind of give a reassurance to the bond market that there is a lower and lower probability of a rate hike, at least in the near term. As far as the overall take on the policy and currency is concerned, typically the first quarter of a financial year is a period when rupee weakens. We do see, the last quarter of the financial year is rupee strength, and the first quarter is rupee weakness. So there is that seasonality that is likely to play out. But given what is happening right now with the policy and given what's happening globally with regard to the interest rates, US rates have actually gone down in the short term by roughly 130, 140 basis points over the last a month or so. We will need to see how the capital flows get impacted by that. But I would typically expect a very kind of range bound rupee here, maybe somewhere between 81.5 to 82.5, that kind of broad range.
Okay, so not appreciation just yet. Mr. Khajuria, your range for the 10-year, and is the rupee appreciation in order at all?
So I think 10-year range, I would see it somewhere between 715 to 725, and it should remain there because it may even go higher than 7.25. That all is a function of how the supply comes in and all. But I think taking a pause right now was quite aligned with how the comfort from current account came out. So I think the way BOP has played out, that has and then a dollar index also fell. So this was the opportune time to look at pause. Otherwise, I think there could have been more volatility on the exchange front. So I think this particular room that was available, more to come from the BOP side, has helped to take this decision. Let's see. I think on the currency side, I see rupee appreciating. The way CAD is playing out, the way I think the export of services is playing out. So I see rupee appreciating, and we may see it moving towards 81.50 or so, unless there is a massive intervention to replenish the reserves, take it back to $650 billion or so.
Okay. Soumya, are you tempted to raise your GDP forecast at all, either because of services or because what the RBI is saying, or because, well, now the rates have peaked, so corporates will have greater certainty and may come in and borrow and invest?
Thank you, Lata. I think that we are already a little bit higher than the market at 6.2%. And Lata, I think the question which you also posted in the morning regarding the RBI very optimistic position at 6.5%. I think one aspect of that, if I can, and ours also, which we can justify, is that the external sector looks pretty comfortable, and the last March 31st numbers of current account deficit now shows that this year it could actually slipping below 2.5%, and next year the number could be well closer to 1.5%. So under such a scenario, currency weakening looks a little bit difficult at this point of time. So from that perspective, external demand remains buoyant. The exports, already the exports of goods and services are projected at in excess of 750 billion. So that could act as an anchor. And in terms of the loan, specific question on loan demand, we are actually witnessing an weakening in the loan demand because the previous rate hikes are now slowly permitting through the system. And my sense is that a higher loan rate than the 15% at this point of time may be a little bit difficult to achieve, because this extended pause and this EBLR mechanism will not allow the rates to decline from the current levels, but to stabilize at this level. So from my point of view, lower demand, domestic loan demand, and support of the external sector possibly could have changed the RBI mind to keep the growth rate at higher than the market expectations.
All right, let me just step away from the macros a little bit and come back to you, Jairam. Again, RBI is trying to expand the footprint of UPI, and now what it has said is that sanctioned credit limits can be routed through the UPI account instead of, say, a regular card, etc. What does this mean in terms of credit card itself as a form factor? Aren't these competing, especially given the popularity of UPI?
Yeah, that's a great question. I think they will end up having some pockets of competition, but overall, I think you will continue to see really strong growth in the credit card side as well. There are two things that I'll point out here. One is that credit card penetration is so small compared to the size of our market and the size of UPI that it's almost immaterial, right? In the larger scheme of things, the number of customers is just really, really small. It's single-digit percentages. But what we have seen is once a customer gets used to electronic ways of doing financial transactions, they use those electronic methods across all form factors. So over these last 2-3 years, even as UPI usage has exploded, what you have seen is that credit card companies and their outstandings, etc., have grown at unprecedentedly high rates. So you continue to see really strong growth in the credit cards business and card spends, etc., even as UPI is expanding. And that happens because the same customers are using both cards and UPI for different use cases. Needless to say, ticket sizes are much smaller for UPI transactions and much larger for card transactions. But once a customer gets used to doing electronic payments, they will do electronic payments of all kinds. The final point that I'll make is that credit cards business is less about the plastic. It's less about whether you bring out the plastic from your wallet and actually swipe it or tap it. It is a business model. Credit cards is a business model where there is an issuer, there is an acquirer, there is a merchant, and there is a network, right? That model of there being these four parties and all engaging with each other, and there being an implied business model where one of the parties funds the transaction and hence everybody else kind of does it in a profitable way. That business model, I think, will survive. Because a pure cost-based model where nobody makes money is a tough one to scale over long periods of time and tough one to give customers a lot of rewards, etc. on. So I think the cards business model will survive. Whether plastic will survive or not, I think that's a big question. Plastic-based credit cards might well be a thing of the past, 5-7 years from now.
Well, plastic is another matter altogether, but the very business of credit cards, Mr. Mundra, let me toss it to you. If you talk about an interchange on credit card, for instance, and if, for instance, RBI says that credit through UPI has to be free, where is the incentive for banks to offer this?
No, but see, I think I agree what is just mentioned about it. Credit card has an inbuilt credit, available. So you have to look like it. I'll repeat that credit card is as a business segment, is a business line. UPI is a transaction mechanism. UPI per se would not be carrying a credit limit to it, right? Isn't it? So I don't think that these two are kind of substitute of each other. One is providing a certain business model, one is providing a linked credit line. Is a different, and UPI will be UPI is a transactional mechanism. And now when you permit the UPI to be linked with the credit card, it is a kind of merger of these two things. And now going forward in this line, the UPI can be linked to a credit line. So I think basic first point is to assess the credit worthiness of a person, provide him or her a credit line, and then give a tool to operate on those credit line. I think we need to look at these segments in a different part.
Okay, but it's interesting. I was under the impression that now credit cards as a business line will be less attractive. I mean, all of us will start opening loan accounts attached to the UPI and get credit sanctioned. So perhaps the Visa and the Master will have to check whether their business is getting lost. That certainly remains a doubt.
Lata, sorry to interrupt you, but look at the practical aspect of it. A credit card company would be prepared to give you a 50,000 credit, 50,000 limit on a credit card with the kind of fees. We expect to get a 50,000 rupees loan sanction from the bank and attached to UPI with the same kind of ease?
Okay. Maybe not. Yeah, I'm still not sure how easy it will work. But if it does, then maybe there is some bit of a challenge for the credit card. We'll have to see how it evolves, sir. Just very quickly, I wanted to ask you, Mr. Mundra, you don't think a businessman will be more willing to take loans now because there is a sense that rates have peaked?
Lata, number one, I think see, if there is an economic sense in taking a loan, so regardless of the fact that whether it's going to increase 25 basis point more or going to remain at this point of time, I really, in real life and in the real business, I don't think that real becomes a determining factor. So since you particularly use the word about a business or corporate, that is why I'm responding this. Yes, probably for an individual who is planning to take a loan, yes, it will be a positive weighing point. Like as an individual, if I am proposing to take a housing loan or a consumer loan, and if I expect the interest rate trajectory in a particular way, then probably I would like to wait and watch. And if I am quite confident that now we are at the peak, then probably would take a decision. But as I said, the credit decision is not the only factor. It is an important factor, but it is not the only factor. So I think it may have some impact, but since the signals are not very clear, we have a panel of economists who can read into it and they can make a certain, outlook about it. But if you look from an individual's perspective, and if someone is reading about the today's pronouncement and governor repeatedly telling that don't take it only as a pause and not as a trajectory, then probably for individual it will not be very easy to make a decision to decide that is a now pause for a long time and one can take a great decision. That's what I would like to say.
Okay. All right. You are certainly sowing a doubt on what the governor meant when he said this is not a pivot, a pause. Okay, just final two numbers from the Economist. Pranjul, are you changing anything, inflation or growth forecasts?
No, Lata, I'm not. One small change, that when we were thinking that rates would be hiked today from 6.5 to 6.75, we were also forecasting a small cut, sometime in early 2024. But my sense is that if no more rate hikes are happening now, we may not even see cuts coming in 2024. So that's probably one change.
Cuts. Okay. So you are at 5.5% GDP and 5.3% inflation?
Yes, 5.4% inflation. Yes.
Okay. Soumya, your numbers are 6.2 for GDP, Does that change, and do you change your inflation?
No, as of now, our GDP forecast, we are keeping it at 6.2, and our inflation forecast a little bit higher than RBI. It is at 5.3%.
All right. We will have to leave it at that, but I think we've got a fair amount of nuances from our guests, Mr. Mundra, Neeraj, Ashutosh, Pranjul and Soumya. Thank you very much. From Ritu and me, that's all we have on this special monetary policy broadcast. We have to go into a break, and thereafter news and views continue.